name is Otaviano Canuto, and I'm a senior fellow at the Policy Center for the New South. And we are here today to talk about how coronavirus has taken down the global economic giants. The data released last week have clearly showed how significant the impact of COVID-19 on the economic activity and jobs has been tremendous. Reports for the first quarter of this year are showing large contractions across the board on countries' GDPs. This recession will be worse than the one associated with the global financial crisis, particularly in the case of the emerging market and developing economies, as we approached in the previous video. The depth and speed of the decline will rival that one of the 30s, the Great Depression in the last century. But will the economy recover swiftly once the pandemic has passed? And when will that be? The shape of that recovery will depend on how successful the containment policies regarding coronavirus will be, as well as the exit strategies adopted by each country, as well as on how cost-effective will be the policies designed to deal with the negative economic effects of coronavirus. We approached the coronavirus curves and how to flatten them in the first video of this series. Let's look at the US economy. The US real gross domestic product diminished at an annualized rate of 4.8% in the first quarter. And obviously, this is the worst outcome since the last quarter of 2008, after the global financial crisis, as you can see. The second quarter is to come even worse in seasonally adjusted annual rate, that is to say, using a rate that is adjusted to the cyclical fluctuations and they are expressed as an annual total. The forecasts are pointing to something like a drop of 40% SAAR in real GDP during the second quarter. This is a level not seen since the Great Depression, as I said. The unemployment rate went up. It hit the post-Second World War high of 14.7% last month, as more than 20 million Americans lost their jobs in April as the lockdowns choked the economy. And the sectoral impact has been, overall. As you can see, of course, there are some sectors like travel, leisure and hospitality, tourism, restaurants, retail, and so on that have been hit hardest, but, it's an overall negative picture. Now let's look at another giant, the euro area. As you can note in the chart, the GDP of the euro area plunged 14.4% quarter over quarter in SAAR, that is to say, annualized rates seasonally adjusted. Remember that the lockdown started to be imposed in the Eurozone by mid-March. And in fact, looking at the figures, we may perceive that the activity was running something about a third below normal during the lockdown. The level of activity has probably bottomed last month in April, but it will only gradually start to recover this month and afterwards as gradually the governments are lifting the restrictions. There is something interesting that may be worth approaching in a future video, which is some differences between the labor markets in the euro area and the US. In the US, the flexibility is that the reliance on unemployment insurance is higher than in the case of the Eurozone. And that's why most likely the unemployment rates will reach a peak in the US higher than in the euro area. There are some advantages and some disadvantages to both. The American approach provides more flexibility to adjust labor from sectors which may be phased out for long to other ones, whereas in the Eurozone, there is a protection in the short term, but the movement through sectors is made more difficult as a trade-off vis-a-vis the stability. Now, let's look at Japan. Japan also another giant being thrown down by coronavirus. The JP Morgan is forecasting a real GDP decline of minus 42% quarter-over-quarter against seasonally adjusted annual rates. Remember that last week, Prime Minister Abe extended the state of emergency as the daily increases in the number of infections remained elevated, and the government took the step to avoid the collapse of the medical care system. How about China? China's activity bounced back in March, as you can see, from the outbreak-induced sudden stop in February, and industrial production and retail sales surged from extremely depressed levels. Although a strong rebound is underway, it doesn't seem likely that GDP grows fast enough, let's say, at 40% in annual rates, so as to make the Chinese GDP and industrial product to return to the levels prior to the outbreak. Fact is that China's rebound this quarter is obviously contrasting sharply with the slump underway elsewhere. We have seen a wide variation in outcomes among the largest economies. Remember that I mentioned a downfall in US GDP around 4.9% annualized rates in the first quarter, whereas the euro area had a downfall of 14.4%, and China then, the first quarter, had a downfall of 34.7%. But obviously this can be attributed to the different timings of the COVID-19 outbreak. But it is, as you can see, the biggest crisis that the world has confronted since the Second World War, and the biggest economic disaster since the Depression of the 1930s. And that pulls everybody down. China's recovery will have to rely on domestic expenditures to the extent that they come back, whereas, let's say, the state of recession in the rest of the world will curb China's possibilities of exporting again. And by the way, China's restructuring, which is likely to be accelerated in the post-coronavirus new normal, also deserves a future piece in our series. But let's give a look at the forecast of the IMF released in mid-April. The IMF forecast suggests that global output per head, per capita, will contract by 4.2% this year, which is obviously vastly more than the 1.6% recorded in 2009 during the global financial crisis. In fact, 90% of all countries will experience negative growth in real gross domestic product per head this year. And this is to be compared with 62 in 2009. Back then, we had China's robust expansion, helping cushion the blow, including bringing up other emerging market and developing countries. Also note the following, as the chart shows. There is an optimistic presumption that the second quarter of this year, of 2020, will be the nadir, and a recovery should start very slowly in the second half of the year, and getting back to positive levels for the GDP in 2021. But note that even with the recovery, the levels of GDP per capita, according to the IMF, at the end of next year will still be lower than the ones of the end of last year. Tough. This is just a picture on middle-income economies. Remember in our previous video how we highlighted the coronavirus as a perfect storm for emerging markets in developing countries. And you have an illustration of this in this chart. Look at how Thailand is suffering the effects of the downfall in tourism, but also, the picture is really gloomy for everybody else. You see India here with a positive GDP growth this year, but much lower than what would be under normal circumstances. And China and India will be the only major emerging economies that will be able to obtain a positive growth of GDP this year. Everywhere else, things are tough. Okay, so what are the possible shapes of the post-coronavirus recovery? Let me give you here, using the nice work done by two scholars of the Hutchins Center on Fiscal and Monetary Policy of Brookings. Let's start with the first one, the most optimistic and implausible Z-shaped recovery. According to this fictitious scenario, the economy suffers a downturn during the pandemic, but then bounce back above the level it would have been in the pre-pandemic baseline, as supposedly pent-up demand creates a temporary boom. But the presumption here is that the part of the GDP foregone in the spirit would be, let's say, recovered. But that's implausible. The shopping that we didn't do, the restaurant meals that people didn't take, the haircuts people didn't have, the trips that were not taken, they were not simply delayed, they are lost. They cannot be made up once the risk from the pandemic passes. So still a very optimistic scenario is one of a V-shaped recovery, as you can see. The economy permanently loses the production that would have occurred absent the pandemic, but very quickly returns to its pre-pandemic baseline once social distancing is lifted. Trips not taken, restaurant meals not purchased, and rock and roll concerts not attended are foregone rather than delayed. But once life returns to normal, everything is just as it would have been before. Well, more likely, we would have somewhat more pessimistic scenarios, like the U-curve or the Nike swoosh curve, as you can see here. The effects of the pandemic on economic activity last well beyond the end of the social distancing, and GDP recovers slowly. Even after the health risks recede, the economy still doesn't quickly go back to where it would have been, though it does get there eventually. In the U shape, the level of GDP stays low for a while, perhaps because social distancing norms last a long time, but then recovers back eventually to baseline, even if it's slowly. In the swoosh here, very close to, but the economy starts to bounce back sharply as restrictions are lifted and economic activity increases, but consumers, business, and state and local governments are still hesitant to spend, and it takes a long while for the economy to get back to its pre-pandemic trajectory. And by the way, interestingly, the US personal saving rates have risen in the last few months. As it typically happens after wars and catastrophes. Curbed expenditures on the items mostly affected by the coronavirus outbreak have helped. Well, let's see now the two other, let's say, more pessimistic scenarios. The W-shaped recovery is also plausible, particularly, for instance, if the response to the pandemic is a first round of openings that is followed by a surge in COVID-19 cases, and other rounds of closures are made necessary, which is a possibility alluded to by many analysts. And of course, we have the most pessimistic trajectory, which is the L-shaped recovery. The pandemic has a permanent effect on GDP, as you can see. Lost investments during the crisis, any rethinking of global value chains that may instill less efficiency, any long period of fiscal adjustment that may follow the stretch on the public sector that is happening right now, some slowdown in productivity growth, all that would have the potential to cause the trajectory of GDP to be lower than it otherwise would. This is basically, this last one, the L-shaped recovery, how the recovery of the US economy from the Great Recession looked like. Despite the fiscal stimulus that happened right after the global financial crisis and all the efforts of the Federal Reserve Bank implementing rounds of quantitative easing, it took 6 years for per capita GDP in the US to return to 2007 levels. And even today, real GDP is still well below the pre-recession projections. So, what will determine the shape of the recovery? At the beginning of the pandemic, few understood how long it would be before life returned to normal. And many analysts talk about V-shaped recovery, or V-shaped recoveries in several countries. This was particularly the case regarding China, without taking into account that even China will have to suffer the consequences of having their export markets dumped by the coronavirus-related crisis abroad. But now, many analysts believe that barring some major improvements in COVID treatment, which would make the disease less dangerous, only a vaccine can allow economic activity to return to the pre-pandemic baseline. Even once the economy starts to reopen, measures will likely be put in place that curtail economic activity to some degree. Travel will be less common. Businesses will have to space workers and customers further apart. Restaurants will be serving fewer customers at a time. And sporting events, concerts, and other activities involving large crowds probably will remain off limits for a long time. And even if the rules allow for that, many people may be reluctant to return to life as it was before the pandemic. So there will be no quick recovery. A key question in that regard is whether damage to the economy's capacity to produce goods and services will be long-lasting. Remember from our discussion on the coronavirus curves that the dream would be to avoid the temporary but deadly impact of the coronavirus associated policies, so as to, let's say, keep things as close to where they were as possible. And the damage that might impede that basically may come from 4 broad categories. The household ability and willingness to spend. When workers lose their jobs, they're likely to drain savings and increase borrowing. They may also delay payments on mortgage and credit cards, and their credit ratings may decline. And they may become more fearful about the future. As I said, the personal savings rates in the US are climbing up because one way or another, that means that households, even once the economy opens up again, may be either unable or unwilling to spend as readily as they did before the virus appeared. Another not, where the damage may be profound, is on state and local government finance. State and local governments generally have to balance their budgets each year, and it took 10 years for state and local employment in the US to rebound to pre-recession levels after the Great Recession. Businesses, the possibility of bankruptcies and lower investment. It takes a lot of work to open a new business. You have to arrange funding, you have to find locations, you have to get suppliers, you have to hire people. And if a business declares bankruptcy and shuts down during the pandemic, that whole process will have to begin anew. That will take time and money and make the recovery slower. In addition, even once the economy reopens, firms may be fearful that it will close again, either from a resurgence of corona or from a new virus, and that may make firms less likely to invest in equipment or research and development. And also, there is the issue, the possible damage through the loss of human capital. The relationship between workers and firms is something valuable, and because employers and workers typically spend a lot of time in finding a good match, and workers then acquire firm-specific skills and knowledge. So if businesses lay off their workers during the lockdowns, those workers might start looking for other sectors or other jobs, or they may leave the labor market altogether. That means that a lot of human capital tends to be lost when you have, let's say, widespread bankruptcy. What can policy do, as we discussed in our video on the flattening curves? Beyond, of course, the protecting public health, which is the overriding objective in this case, the government can do a lot to ensure that the recovery is as close to the Z that we saw as possible. And in fact, a wide range of tax and spending policies have been implemented this year. They are estimated to add to something close to 2.7 percentage points of global GDP growth this year, compensating partially the loss for the other reasons. And this is definitely a larger impulse than the one that was given after the global financial crisis. Basically, these tax and spending policies combined with support to credit, they are aimed at smoothing the income streams for households, as well as making sure business are able to get access to credit. Now, question is, how does this follows in each country? This will be the subject of additional videos in this stream that we are preparing. We intend to approach the strategies of exit from coronavirus containment policies, as well as how it is that the post-coronavirus new normal is likely to look like. Stay tuned.